So, Michael, they're entering one of the toughest job markets in decades. They saw the tech bubble burst. They saw the housing crash. Can you blame them for not jumping into the stock market?
I cannot blame them at all, and I am one of them, so I can take full responsibility for that. You know, I think it's tough. We were raised in a period of time where there was such economic prosperity. You know, we saw incredible wealth, we saw opportunity, and then we entered the job market, and look what's happened. I feel like it's only natural for them to be some sort of skepticism there.
I guess the bigger question is this a problem? They certainly have missed out on a nearly 200% rally from the March 2009 lows in stock markets. They're not getting that in cash or anywhere else.
Yeah, I completely agree. You know, it is a problem, especially if we're looking long term, right? I mean, short term, the problem is that folks don't have a lot of capital to invest. They really don't understand the market. There's a lack of education, and there's that mistrust. In the short term, yeah, I'm not so sure that I blame them, but in the long term, it's certainly hurting them.
But Michael, you know, there are a number of other studies out that show that at least they are creating some type of plan. They have some strategy and priorities in terms of where they want to put their money, and saving is actually a #1 priority, saving for retirement. The problem is, of course, that they're putting that money in cash, but the fact that they're looking at saving, the fact that they understand the importance of paying off that student loan and credit card debt as financial priorities, that may be something that also hindered some of their parents not having a plan at all.
Yeah, that's actually true. And if you look deeper, you'll see that we're actually better savers than the generation before us, better than the boomers. So we do understand the value of saving. We're saving from a younger age, but where we're putting our money, very different. And it really comes down to that mistrust. We saw what happened to our parents, and we don't want it to happen to us.
Well, not only that, but our parents had better pension cushions. I mean, it was a completely different ballgame, not to mention that during 2008, 2009, they saw their retirement accounts get wiped out.
Absolutely. We learned from that. Those were our formative years, and today we're investing and we're acting a little differently because of it.
And I think there might be some hesitancy, too, Michael, in getting advice from financial advisors, from people who are actually in the markets. More so, a lot of millennials seem to want to go to their family, to their friends, and that's not necessarily where they're going to get the most astute advice on where to put their dollars now for long-term growth.
That's really true. You know, what's funny is that, you know, we're overeducated. We've all gone to college. We all have that student loan. But when it comes down to it, when it's about sort of fiscal education, we're just not as smart. There have been numerous studies, including by the Department of Education, all showing that our fiscal knowledge is less than our parents before us. And that's a real danger.
Well, it's going to be a discussion, too, about what it means broadly if it's a structural problem for the stock market. But for now, Michael and Sharon, thanks very much.
Sure. Thanks for having me.